Welcome to Short View Trading, it's your morning market hit for Monday 6th of March. It's around 9 a.m. London time. So if you're a swing trader, if you want to trade equity markets on a 1 to 2 week basis using equity index futures like S&P 500 futures and similar, what should you be looking at? What should you be thinking about? What are the key factors that are going to drive these markets over the next week or two? That's what we want to talk about in this video. So let's dig in. Well, it's been a fascinating few weeks in equity markets, all changed compared to what we saw in January into early February. At that time, markets were really somewhat euphoric, surging tech stocks, massive buying of call option volume by the retail space, and all sorts of euphoria building in equity markets that peaked out in early February as we flagged up in these videos and as you could see from our sell-off indicator at that time. Since then, markets have been trending lower. They've trended down since the 2nd of Feb intraday high on the S&P 500, that key 4,200 level that the market got to, a 50% Fibonacci retracement level. And since then, equities have struggled. The US equity markets in particular have trended lower, other than bouncing in the last day or two at the back end of last week. Now, behind that is what's fascinating. Of course, part of what's driving that is the pricing in a higher terminal Fed funds rate. As you can see from the chart in front of you now, the August Fed funds implied rate is up at 5.44, up from 5% at the start of February. Along with that, other Fed funds futures contracts also up, pricing in higher rates across the next several months. And with that as well, of course, 10-year bond yields bouncing to higher levels, back at their high levels at the back end of last week when they touched on 4.08 close on Thursday on a yield basis, similar to where they were a couple of months ago. So yields are backed up, 10-year yields are backed up, Fed fund futures have priced in more hikes. And with that, we've had a tightening of liquidity, as you can see in the behavior of gold in front of you, the chart in front of you now, the gold price action topping out with gold topping out in early Feb, 2nd of Feb, similar to the S&P 500 and really struggling since then. So liquidity indicators have struggled and given back some of their gains, gold, silver, Bitcoin over recent weeks. And with that, equity markets have tightened up and struggled to make any headway. In fact, they've given back gains from that key 4,200 level. So the question is what now? And of course, now it's all eyes on Jerome Powell. All eyes on Jerome Powell on Tuesday and on Wednesday. Humphrey Hawkins' testimony, as it used to be known, when he goes up to the Hill, gives two testimonies, one on Tuesday and then again on Wednesday. Similar speech, but perhaps different Q&A. And the market gets a real sense of where's Jerome Powell at. Now, of course, given what Fed governors have been saying in recent weeks and given the robust economic data relative to expectations, just look at Atlanta Fed GDP Now forecasts, which are running at 2.3% for Q1 versus the blue chip consensus for this quarter, i.e. the consensus of the Wall Street economists, which is running at about 0.5%. And you get a sense of how robust the data has been in recent days. So the data has been more robust since Powell last spoke. Fed governors have been talking up hawkishness and talking up the terminal rate. So it's likely you would have thought that Powell's going to be tilting towards the hawkish side when he gets up to speak on Tuesday and again on Wednesday. That'll be critical, as will the positioning of our models. We saw the models get close back to buy last week, although they didn't quite make it. We also had the S&P 500 faffing around, testing and finding support at its 200-day moving average around 39.50. And with that, we've had what we would call a wave 2 relief rally, a bit of a bounce after the prior 3-4 weeks of weakness in equity markets, which may well sustain itself. That bounce may well continue into Powell tomorrow and perhaps a little bit beyond. So the models are bouncing, as you can see from the chart we put up in front of you, and they're moving back towards sell levels, which I think is kind of interesting, particularly if we get the kind of tone out of Powell that I would expect he'll deliver on Tuesday. And over and above that, all the while in the background, we've got this ongoing breakdown in the correlation between implied volatility in the bond market and implied volatility in the equity market. As you can see in the chart in front of you now, the VIX, implied equity volatility, and the MOVE, implied bond market volatility, have broken away in recent trading sessions. Normally, they correlate quite tightly together. Of late, they've stopped correlating. So the key question is, how does that correlation re-establish it yourself? Is it the VIX going up or the MOVE bond volatility index going down? Now, much of that will come down to how it's Jerome Powell on Tuesday and Wednesday. But if it's the VIX moving up, then clearly it's negative for equity markets over the course of the next week or 2 or 3. So if you want to hear more from us each and every day, please take a free trial of the Daily Rag, also known as the Rag Trader. Simply click on the link below, or if you're a subscriber, you should have the email in your inbox by now. Comes in about 8:30, 9 a.m. every morning London time with our updated views on how we feel about the market, a recommendation on S&P equity futures, and some thoughts and latest updates on models and thoughts on markets for you to digest. So what are we watching this week? Well, there are 3 key themes. As I mentioned, Jerome Powell speaking on Tuesday and Wednesday. Christine Lagarde also speaking on Wednesday, the ECB president. So those will all be watched closely. Secondly, there's a jobs theme in the US, culminating on Friday with non-farm payrolls. But ahead of that, we got the ADP data, the JOLTS data, and the Challenger layoffs. All of those will be watched closely, especially after the very strong monthly payrolls last month. And then over and above that, there's a bit of a Chinese macro theme with total social financing coming out at the back end of the week, along with CPI and PPI out of China. So that's it from us. That's your morning market hit for Monday, 6th of March. Thank you for listening. Please do subscribe on YouTube. Simply click on the subscribe button and like and follow to receive these videos, or follow us on LinkedIn, Twitter, and or Facebook. Thank you for listening. Stay safe. Trade well.